Hi, this is Dr. Gregory, and this is ACC4620 Auditing and Assurance 2. This is the second part of our lecture on Chapter 6, where we're going to focus in more on the auditing procedures. Now, we have two major categories of audit procedures. One is the test of controls, and the other one is what we call substantive procedures. So under the test of controls, we want to know how effective are our different controls. So if we were looking at whether or not we've got a good control environment over our accounts payable, we might be able to do a number of different procedures, such as inspecting the procedures of those documents, observation of the process, maybe we watch or do a reperformance of the process, and we can also inquire with management as to their control-related responsibilities. The second category is called substantive procedures, and those are whether or not there are material misstatements in the financial statement. And again, there's a lot of ways that we can go about identifying different procedures. We can inspect documents connected to the financial statements. We can look at assets. We can do external confirmation that we covered with third parties. We can do recalculations. Sometimes we re-add up the inventory list if they give us a list on an Excel spreadsheet to make sure that their spreadsheet and the financial statements match. And we can do different types of analytical procedures, including scanning, looking at the journals, and doing some inquiry. Now, when we're looking at the different types of audit procedures and assertions, one of the things we have to really think about is what we call the cost-benefit analysis. If you have a low-risk item, you probably are not going to put a lot of substantive testing behind it. So you need to review each of the accounts, each of the controls, and document whether or not there is a high cost benefit or a low cost benefit to performing substantive tests. So the first thing we want to do is look at the different types of tests. One is the existence. We can inspect assets. We can trace those documents from cradle to grave. We look for completeness. Are those source documents complete? Do they have a purchase order? Do they have a receiving report? Do they have an invoice? Is there appropriate signatures on everything? Double check the coding. Does the coding match what the expense was? We want to look at the rights and obligations as well, such as, does the evidence reflect that the company has the right or obligation to include that asset or that obligation on the financial reports as an asset or a liability? Do we have ownership, or do we have substantial control or a right to own that asset or that liability? You want to make sure no one's slipping in invoices and payments that don't belong to the company. We want to take a look at and confirm the asset price for invoices. Do we want to ensure that the assets are properly valued? And that's including salvage life. We want to make sure that we have the proper salvage life. For example, you may have a police department that you're auditing. Well, there are different types of vehicles. There could be the administrator's vehicle, which he or she uses in their daily course of business. And then you may have a police vehicle or a fire engine or paramedic ambulance that may have a different valuation. So you want to take a look at that. And you probably want to recalculate the depreciation schedule or the allocation schedule of mortgage balances. You probably want to do a recalculation of that to make sure that they calculated it correctly. And finally, you want to look under presentation and disclosure. Is the financial statement complete? Is it missing anything? Do we have accounts not listed in those financial reports that should be? Sometimes they will just print a report from their system. Well, you might have to double check and make sure that the system is pulling all the accounts correctly into that report. I've seen cases where we've looked at reports and then we found anomalies. Go back to the schematics of that report, how it was developed, what accounts were used, and find out that the wrong accounts were used to pull, or the wrong dates, or the wrong amounts were being pulled. So you want to look not only at the financial statement on its face, but what is going into that financial statement. And finally, are all the disclosures correct? And are they included? Was there a change in accounting estimates or principles that we have to make sure that we include? Did they adopt and implement a new standard? And what was the effect of that standard? We also want to look at the timing of these procedures. It's important to know where we have the period being audited, the balance sheet date, the subsequent period post of the year end, and then the cutoff period. So while the period being audited or up to the point of being audited, anytime to the end of the fiscal period, can help with efficiency and create an earlier completion of your audit, there is a high risk of misstatements because the information may not have all been posted by the time you're auditing it. So those balances may not be true. We can do it at the balance sheet date or any time in that cutoff period. Usually it's like sometimes a couple of weeks after the end of the fiscal period or the end of the fiscal cycle that we can do the cutoff period. The problem with that is that there's a high risk that you're dealing with two periods of time, the prior year and the future year, and there is a greater risk that there may be transactions flowing through the wrong period. So you have to take much more in-depth look at that to make sure you've got things going into the right period of time. And that also holds for subsequent periods. Make sure that if we've got things that should be rolled back into that prior period, that we do that and make sure that we don't have things in a subsequent period that belong in a prior period. Let's shift over to analytical procedures. Besides our regular source document testing, transaction testing, asset verification, we also want to do some analytical procedures. Why? Well, we want to get some benchmarks going. We want to see what's been going on this year as compared to years in the past. Are there some anomalies present? So we want to first set up a plan. Which accounts have the higher risk of misstatement? If we are a construction company, it could be inventory items could have a high risk of misstatement. It could be we have labor issues that could be a high risk of misstatement. So you want to think about that, but it's not really very precise because it's based on what you know of the industry. So the more knowledgeable you are with the goings on in that industry, the more precise you're going to be in planning which accounts could have some material misstatements. The second step you want to do is you actually want to perform the procedures. You want to obtain your evidence to support or refute the assertion. And we already know what evidence is. It's anything that supports or refutes our assertions. Now, evidence is much more precise because it's right there. We're not guessing. So that when we're actually performing it, we want to be as precise as possible. And finally, once we're done, we want to review what we did and say, based on the analysis, are the financial statements consistent with what we understand the entity to be? Again, it's less precise because again, it's based on your knowledge of the industry. That's why we go back and keep saying, if you're going to be involved in certain industries, you have to understand those industries very, very well. And then you have to think about, well, is my expectation different than what the client performed? So if the client says they had a really great year, but in our analytical procedures, we have obtained evidence that they shouldn't be doing very well, we have to think about that. Are our expectations and our results consistent with what management is talking about? So when the risk of material misstatement is high, there has to be a low acceptable difference between your expectations and your client's expectations or their assertions. Now, here we go. Let's talk about some more in depth about analytical procedures. So we've kind of done our planning, we've done our performance, we've done our review, and we can look at now some additional substantive analytical procedures. Now, remember, always have to put that cost benefit in play and make sure that we are approaching all of our testing and analytics with that in mind. So there's a few typical ones you've probably studied throughout your introduction, your management accounting, and your higher levels of advanced accounting, and that's trend analysis. You can perform both horizontal and vertical on income statements and balance sheets, and we can use that to compare to prior years. We can compare that with our competitors, and we can compare that to industry benchmarks to see where we sit and is what management is asserting to us as to the overall operations of the company coming into play the way we are creating that analysis. The second type of analytical procedure we can do is ratio analysis. Profitability, liquidity, solvency, and it's to detect those unexpected results for further investigation. Now, you have to understand that if anything changes from year to year, that's going to change the outcome of those ratios. So you have to understand the components of those ratios and whether or not over the years those components have changed over time. And finally, this is the least rigorous, but it's something that we usually do at the end in order just to give it one last view, is we do scanning. We just start, I take my hand and I run it right down the transactions, and I'm looking for anything that's unusual in amounts. If we usually have miscellaneous expenses at a very low percentage, maybe 0.5% of the total expenses, and all of a sudden I start seeing some large numbers popping up, I'm going to want to investigate those numbers to see that maybe that was a miscalculation, or maybe they're moving expenses into inappropriate accounts to avoid overperformance or over expenditures in other accounts. So you look for unusual amounts, unexpected balances, always look at miscellaneous revenues, always look at miscellaneous expenses. Those are good ways to find simple errors that come up. A little bit more about analytical procedures is regression analysis. And that is a statistical analysis that's done. It's the most rigorous approach. And it basically, we basically have an expected or predicted value of something, and we determine the various factors that are used in predictions, and then take a look and see whether or not those predictions are holding true. So for example, we could look at revenue in retail stores based by square footage, do larger square footage stores with more inventory lead to higher revenue predictions or expectations. We could look at employment data depending on the amount of employees. For example, Do more employees in the production department result in higher volumes of inventory that are available for sale? We could look at geographical locations. Are certain areas of the United States or globally a predictor of revenue expectations? And here are just two more to look at that the book calls out. One is management estimates. Estimates are just what they are. They're sometimes educated guesses, but they have to be based on some type of rationale. I audited a company once that had some really unusual estimates as far as their allowance for doubtful accounts. And I said, where is your underlying rationale? And what came back to me was, well, the boss says post X or post 10%. Why? Well, that's what we've done every year. Well, is that really a sound rationale? So when you look at those general ledger entries that are posting allowances and warranties and estimates, make sure that there's underlying rationale and make sure that the rationale makes sense. Why 10%? Is historically 10% what they're writing off? If they're only doing a 10% allowable for doubtful accounts, but they're writing off 15%, then we've got some issues we want to talk to them about. And maybe their rationale needs to be rethought. And then finally, related party transactions. Now, related party transactions, for the most part, are totally legal, totally ethical, as long as they are within the normal course of business. For example, if you have a vice president of a bank that sits on the board and the company does business with that bank, are they getting loans that are the same in the normal course of business as anybody else would get? Or are they being given preferential treatment? So you want to dig into those types of things. So as long as there's no more risk associated, it's fine to have that related party transaction. One, we like to disclose it. And two, we like to confirm that it is no different than any other person would get. So look to the underlying motivations. If you look at a bank loan and that bank loan is 1%, when bank loans at that company are typically 6 or 7%, we might have a problem. There might be a motivation for the company to have that person sitting on the board in order to get preferential treatment. So there's a risk of the misappropriation of those assets, the loans. One thing we want to do is have a really good understanding of the accounting information system, the AIS, the accounting system that the company has, because you're going to probably want to run some reports on vendors with vendor names, who owns those vendor companies, and whether or not those vendor companies are owned by people who might be related to people in the company, where that might give you, again, that motivation to misappropriate assets. So what we covered briefly is the different types of audit procedures, management's assertions, and the audit procedures to follow them. When should these procedures be performed? What type of analytical procedures we could do? What we do with how to determine estimates and the rationale behind estimates. And finally, related party transactions. As always, please read your book carefully. This is just an overview. Reach out to me if you have any questions, and I'll see you in the classroom.